Good afternoon, everyone. Welcome to today's Charity Village webinar. We will just wait a moment for everyone to join the session. Okay, we will get started. Welcome to today's Charity Village webinar. My name is Mercedes, and I'm the Marketing and Communications Specialist with Charity Village. As we are gathering here on a virtual platform, it is important to acknowledge that each of us is joining this webinar from the ancestral or unceded lands of the Inuit, Métis, and First Nation people. As a settler on this land, I'd like to acknowledge that I'm speaking to you from the traditional, ancestral, and unceded territory of the Anishinaabeg, which includes the Ojibwe of Fort William First Nation. For those who may be joining a Charity Village webinar for the first time, Charity Village is Canada's largest online job board for the nonprofit sector. In addition to our online job board, organizations can also post volunteer positions. So if you are looking for work or to recruit talent in the sector, Charity Village is a great place to start. We also have a ton of excellent resources for nonprofit professionals, including online courses, articles, fundraising tools, and free webinars like the one we are presenting today. Before we start today's webinar, I would like to quickly run through some housekeeping items. You may have noticed when you joined the webinar that you were automatically put on mute. Since we have hundreds of participants in today's session, it is important for us to minimize the amount of background noise so that everyone can clearly hear the presentation. But you can still ask questions and make comments using the question box at the bottom of the Zoom control panel. Look for that at the bottom of your screen. We will be taking questions at the end of the webinar, so please submit your questions as you think of them, and we will do our best to get to as many as possible. You can also email your questions to webinars@charityvillage.com. If you happen to encounter any technical issues with the webinar, whether with viewing the presentation or with the audio, please let us know in the question box or by sending us an email. We will do our best to get any technical difficulties resolved as quickly as possible, but in a worst case scenario, please remember that we are recording today's webinar and we will send you the full recording by email tomorrow. So if you get called away or disconnected, you will still be able to view the full presentation. And with that, I'd like to welcome our presenters for today, Omar Visram, the co-founder and CEO of Enkel Back Office Solutions, Christine Kessler, the director of the NPO division at Enkel Back Office Solutions, and Shirley Wolf, the Senior Controller at Enkel Back Office Solutions.
Great. Thank you so much. We're so excited to be here today. The topic for today is Financial Statement Bootcamp, how to read, understand, and use financial statements to run your nonprofit. For those of you that don't know me, my name is Omar Visram. I am the co-founder and CEO of Enkel. On our team today, we have Shirley Wolf, Senior Controller of our NPO division, and Christine Kexer, Financial Controller of the NPO division as well. A little bit about Enkel. Enkel means simple. We strive to simplify the financial operations of our clients. We were co-founded in 2016 with a simple problem in mind. You can't build a great organization without good books. Today, we have 300 clients. We've worked with over 100 not-for-profit organizations across Canada. We have 80 team members with a global delivery model. And our focus is on financial operations, not advisory, tax, and assurance work. Enkel would like to acknowledge that our offices are situated on the unceded traditional territories of the Musqueam, Squamish, and Tsleil-Waututh nations. In terms of services that we provide, our clients today purchase from us some combination of these 5 services. So our core services are bookkeeping, payroll, accounts payable processing, accounts receivable, and controllership services. Before we go further, and before I hand it over to Christine, I just wanted to take care of one quick housekeeping item. If you can please include your email along with your question in the question and answer box. While we strive to answer as many questions as possible during the webinar, we will also follow up with you if we aren't able to get to your questions. Now I will hand it over to Christine.
Thanks, Omar. So let's take a look at our agenda for today. We're going to look at cash-based accounting versus accrual accounting. And we're going to explore the core financial reports and how to use them and read them and interpret them. And we're going to talk about revenue recognition and why it's important to your nonprofit. So we're going to kick off our webinar with a polling question. We want you to rate your ability to interpret and understand your financial statements. And it's on a scale of 0 to 10, 10 meaning you have a strong understanding. We'd love to gauge where you're at. A lot of times we're reading financial statements and there's portions of it that we're not able to interpret, or maybe all of them look like they're in a foreign language. And that's why we're here today. So we encourage you to participate in this poll. We're going to leave the poll open for a few seconds to allow everyone to have a voice. And so please submit your poll now. There's a great number of you that are participating. And again, 1 would be, I have no idea. And 10 would be, I have a strong understanding. Okay, we've got a really good portion. We're up to over 80% participation at this point. So we're going to close the poll now. And the poll results are actually pretty spread out. So we've got, and I'm going to share the results with you. We've got about 5% of people that answered saying they've got a really strong understanding. And then maybe 6%, around 9 out of 10. Our highest numbers sit around 5 to 7. And so it's showing that we have sort of a median knowledge of financial statements. So that's great. It's exciting to know that you're here and we're here to help, hopefully get you closer to a 10 today. So what we hear often is accounting can be hard, or people will say, I didn't like math in high school. So we want to talk to you about, sometimes accounting can be complex, but you don't need to be an accountant or a finance expert to understand your financial statements. But what's really important to understand is that it is your responsibility, especially if you're on the board of directors. The executive director and the board of directors should strive to acquire a basic understanding of finances and have the ability to interpret, assess, and be able to question those red flags or things that might look a little off in the financial statements and other information. It is your responsibility. So turning to experts for help and advice is absolutely appropriate. But making financial decisions on behalf of the organization is the responsibility of every member of the board. And there's sometimes a misunderstanding there where it's just the finance committee or just the chair. It's the entire board. So welcome to Financial Statements Bootcamp. We're really glad you're here. So why is it important to understand your financial statements? Well, like we've touched on, it's the board's legal responsibility to ensure that the organization is protecting its assets, paying its bills, compensating its employees, and correctly managing revenues and donations. Donors and funders rely on you to manage and disperse these funds. And they've entrusted your organization and are expecting integrity and accountability. Your organization is subject to guidelines and policies that it must adhere to that directly affect how you report, manage, and spend these funds that have been entrusted to you. So interpreting the financial information presented to you is imperative to fulfilling these responsibilities. So let's look at cash-based versus accrual accounting. The main difference between and you might have heard these terms before. The main difference between these two is the timing of when you're recording your revenue or expenses. So we're just going to kick off with an example. You've received an invoice for consulting fees, and The consultant provided these services back in August, but you've just received the invoice in now. We're in October. You want to record it and you want to pay it now. So cash-based accounting records the expense and the payment in October, even though the fees were actually incurred in August. So let's say your consultant was consulting for an event or program that was running in August. Cash-based accounting is going to record that in October. So not in the month that the actual program or event took place or when these expenses were incurred. Accrual accounting, however, records the expense or the bill for consulting back in August when it was incurred. And then the payment is going to be recorded in the month that you actually made the payment, which is October. So why would we want to choose one over the other? Well, cash-based accounting is more simple. It's less complex. It's used by a lot of small businesses, self-employed individuals. So people that just have a little business, they'll run cash accounting. Statement of operations align with your cash flows in and out, meaning your revenues and expenses will always match your bank statement. Accrual accounting, however, follows generally accepted accounting principles. It's required for some organizations. It provides a more accurate view of your organization's financial performance, and it is required for audits or review engagements, and it may be requested by stakeholders like a funder. It is a more accurate picture of your organization's financial position and sustainability. So we're going to take a look at an example here. Cash-based versus accrual accounting. The top example is cash basis. So the revenue that is coming in is based on money that was deposited that month into the bank. The expenses are expenses that were paid that month. It's cash basis. You can see what ends up happening is in October, it looks like we've taken a big loss because we've maybe paid a lot of bills that month, but we didn't get a lot of bank deposits. And then in November, it kind of evened out. And then in December, it looks like we suddenly had a surplus. With accrual basis accounting, you can see things look a lot more even, a lot more in line. We're recognizing revenue when it's actually incurred and expenses as well. So it provides you a better picture and a more accurate picture of the funds that are coming in and out of your organization. So in a nutshell, while the cash basis of accounting is a simpler method, the accrual basis of accounting presents a more accurate picture of your organization's financial position and operating results because transactions are captured in real time in the period that they occurred. So I'm going to turn over our webinar now to Shirley Wolf, who's going to walk you through financial statements.
Thank you, Christine. In this next section, we're going to be looking at the core financial statements and their main elements. Senior management and boards normally focus on three key financial statements, and they are commonly referred to as the balance sheet, the income statement, and the cash flow statement. You might be familiar, though, with different terminology because these statements are referred to as the statement of financial position, the statement of operations, and the statement of cash flows in the accounting standards for not-for-profit organizations. But they're essentially the same thing. So these financial statements will include your current period information, but it's also useful to think about comparative information that you may want to include, such as the corresponding period of the previous year, so that you can understand trends in the financial position and the results of operations and cash flows of your organization in the current year. Budgets are also an important management tool as they are normally aligned with the strategic plan of the organization and the goals for the current year. So it's also helpful to include budgeted revenues and expenses and variances of actual revenues and expenses to the budgeted numbers in the statement of operations, so that management and the boards can track actual results against those that were expected for the particular period. We also recommend adding a commentary section to your financial statements. So this is an opportunity when you can explain any significant or unusual transactions, variances, and trends. And you could also consider adding some ratios that may be appropriate for your organization and any key performance indicators that are important. If you prepare your annual financial statements in accordance with the accounting standards for not-for-profit organizations, those statements will also include a statement of changes in net assets and notes to the financial statements. The notes to the financial statements provide more information about certain balances in the financial statements. But we're now going to take a deeper dive into each of these three core financial statements, starting with the balance sheet. So what is the balance sheet? It's essentially a snapshot that indicates the organization's financial position through its assets, liabilities, and net assets or liabilities. You can think of assets as the resources that an organization controls and that it can use for the benefit of the organization. Liabilities, on the other hand, represent amounts that the organization owes to other parties. The net assets represent the assets less the liabilities of the organization, and they would be referred to as net liabilities if the liabilities exceed the assets. You can also think of the net assets as being the retained surplus or deficit of the organization. The balance is an important concept for the balance sheet. It essentially means that the assets equal the liabilities and the retained surplus and deficit. So there's normally a total line for the assets and then a total line for the liabilities and the retained surplus or deficit. So let's look at some of the examples of assets that are commonly included in the balance sheet. So firstly, our bank accounts. So these would typically be the operating checking accounts, and there may also be savings accounts that an organization has, together with investment accounts. So we have some clients that hold investments in GICs, term deposits, and mutual funds. And then capital assets as well. So again, I can think of some of our clients that own buildings, or purchased IT equipment or furniture. Other items that are commonly on a set of financial statements are prepaid expenses. So these represent expenses where there's been a payment in advance for goods or services that you'll receive in the future. A typical example is insurance, where usually a premium is paid at the beginning of the policy period, and that policy period may extend for the next 12 months. Some examples of liabilities that we also typically see on a balance sheet for a not-for-profit organization are deferred revenue or deferred contributions, and also receivables for grants or other sources of funding. Deferred revenues or deferred contributions can be thought of as a parking space for monies that you receive from members, if you're a membership organization and are collecting fees from members, or perhaps from funding organizations, and that cannot be recorded in revenue until such time as certain criteria are met. On the other hand, you may actually not have yet received any monies that are due to the organization, but you're entitled to receive them. And in that circumstance, you may want to actually issue or record rather a receivable for the amounts that are due. Accrued expenses are recorded if the organization's received goods or services in the period, but has not yet recorded a supplier invoice and accounts payable. So an example is one that Christine spoke about a little bit earlier, where the consultant provided services in August. The invoices, in fact, only received and paid in October. So when you're preparing your August financial statements, you may want to think about those services that you've received and record an accrual for those. Because you haven't received the invoice yet, you may in fact need to estimate the amount that's received, and that may be perhaps based on a quote that you've received from that particular consultant, or perhaps an agreement that you've signed with the consultant. The other item in the balance sheet are the net assets or liabilities of the organization. There may be more than one category of the net assets on the balance sheet. So, for example, the board may have passed a resolution to internally restrict a sum of money that's to be used for a specific purpose in the future. Or you may have received an endowment from a donor, and that would be shown in a separate category within your net assets as well. So if this were the situation, there would actually be three categories of net assets: unrestricted net assets, the internally restricted net assets, and the endowment funds. The next slide shows an example of the asset side of a balance sheet for an existing not-for-profit organization that we're anonymously referring to as sample charity. So you'll see this charity has cash and cash equivalents, being the checking and the savings account. It also has what is referred to as restricted cash. I can think of an example in British Columbia, where certain organizations receive grants from BC Gaming. And BC Gaming specifically require that a separate bank account be set up, and that the monies received under this grant be deposited into that bank account and paid out of that bank account. And so that bank account is what we refer to as being an externally restricted account. And this may be the restricted cash that we're seeing in this balance sheet. It also has accounts receivable and prepaid expenses. There also are some long-term investments. So those could be term deposits that we mentioned that may be for longer than a 12-month period, or mutual funds. And then it also has some property and equipment. So you may have noticed that the assets are grouped into two categories, current and non-current assets. So current assets normally refer to cash and other assets that are expected to be converted into cash within 12 months after the balance sheet date. So for example, accounts receivable are normally due within 30 or 60 days after the invoice date. Sample charities' current assets include cash, accounts receivable, and prepaid expenses. And all of the other assets are included in the non-current category. So we're now going to look at the liabilities and net asset side of the balance sheet for the same organization. So sample charities' liabilities include accounts payable, credit cards, payroll liabilities, accrued liabilities, and deferred contributions. The liabilities are also grouped into current and non-current categories. So current liabilities are those liabilities that will be paid within 12 months following the balance sheet date. The accounts payable, accrued liabilities, and deferred contributions are commonly included in this category. If sample charity had a long-term loan, that would be included in the non-current category. The equity section represents the accumulated surplus of the organization. So coming back to assets now, you may have heard of amortization of assets and an amortization expense, and also accumulated amortization. So what are these exactly? These normally refer to capital and intangible assets, and the amortization refers to the loss in the value of that asset over a period of time. Assets can generally lose value through regular wear and tear, through obsolescence, particularly in the context of information technology, or it could possibly become damaged. So accumulated amortization is the accumulated balance of the amortization on the balance sheet, and this offsets the cost of the asset. So the sum of the asset's cost and its accumulated amortization is referred to as its net book value. So we're also going to take a look at an example, and this is with organization Charity 123. So the charity buys a computer for $4,000 on January the 1st, 2023. Management need to estimate the useful life of the asset, and this estimate is 4 years. And the year end of the organization is March the 31st. The organization's also chosen to calculate the amortization on a straight line method. So what happens in the financial statements from 2023 to 2027? So we'll see in 2023, the cost of the asset is $4,000. So that's when the asset was acquired. Amortization is calculated just for 1 quarter, being the last quarter in the fiscal year for the organization. So that is at $250. So we've taken the cost of $4,000, divided it by 4 years, which is $1,000, but we then need to divide it by 4 for just 1 quarter, and that calculates to $250. So at the end of the fiscal year, March 31, 2023, the accumulated amortization is also $250, and the net book value is $3,750. For the next 3 years, the organization is going to recognize a full year of amortization of $1,000 on the asset. And you'll see in the accumulated amortization balance continues to accumulate by the amount of the amortization. And then in 2027, the remaining amount of the amortization is recorded. And at the end of that fiscal year, the net book value is 0. So from an accounting perspective, we use what is called an historical cost to account for amortization. You may be holding a building or some land possibly that appreciates whose market value appreciates over time. But we don't use the market value to account for the asset values in the financial statements. So what could your balance sheet be telling you? Your financial statements are not just a set of numbers, they usually tell a story. And so we're going to be looking very closely at what the balance sheet is actually telling us. So if your liabilities exceed your assets, you may have a problem, because you may not, in fact, have sufficient assets to cover your obligations. This may lead to you borrowing monies received for Program B, say, to cover the liabilities related to Program A. And this could actually be a contravention of your funding agreements. So you may need to consider a short-term loan or possibly ways to generate additional unrestricted revenues and to reduce the costs of your organization so that you can get your organization back to a net assets position. So timing is also important. So we spoke about those categories of current and non-current items, which we're just referring here to short-term and long-term items. So it's important to understand what needs to be paid and settled and when that will take place, and also when your assets are going to convert to cash. You always want to make sure that you have sufficient current assets to pay your current liabilities when they become due. There may be a need to regularly follow up on overdue accounts receivable balances to ensure that cash is available when it's needed. On the other hand, you may actually have an excess of current assets over current liabilities, and you may want to invest some surplus cash in longer term assets so that you can generate higher returns. And this is particularly appealing in our current environment where interest rates are relatively high. And so you could choose to invest in lower risk investments such as GICs and term deposits to take advantage of those higher rates. You also may need to be in a situation where you would like to improve the liquidity of your organization. So think about how you could collect money faster, perhaps pay your vendors a little bit slower, and also perhaps there may be a need to take on short-term financing to protect the organization if there is a liquidity problem. Of course, this may not be a desirable avenue in today's environment as well with the higher cost of borrowing. So you may want to just look at other measures where you may not need to incur interest costs. So we're now going to turn to the income statement, which, as I mentioned, is also sometimes referred to as the statement of operations. So this essentially measures your revenues and expenses over a period of time. And you could really select what that time period is. It could be the month, it could be the year to date, or perhaps the past 12 months. So your revenues less your expenses represent your net surplus or deficit for the period. Or we could also refer to that as being the excess or deficiency of your revenues over expenses. Revenues can come in a variety of sources, such as donations, grants, government funding, membership fees. You may also be providing services and receiving a fee for those services. You could be selling merchandise as well. Expenses represent the costs for purchases of merchandise, services, or supplies. Many organizations will track their revenues and expenses by program, which in some accounting software is referred to as a class or a department. This is very useful for organizations that need to track program revenues and expenses for accounting purposes, and also for reporting to funders. And as we mentioned earlier, ideally you're comparing those actual revenues and expenses to your organization's budget that's been approved by the board. On the next slide, we're going to take a look at Sample Charities Statement of Operations. So this organization receives revenues in the form of donations and also grants from foundations and governments, and it earns revenue on its investments. The expenses include costs for salaries and wages, which normally are a significant portion of the overall expenses of a not-for-profit organization. It also has program expenses and other expenses such as accounting and audit fees, rent, insurance, and other administrative costs. And then in 2022, for the entire fiscal year, the organization had a surplus of almost $23,000. So again, what could your statement of operations be telling you? This would certainly track your progress relative to the budget that was set at the beginning of the year. And it could also show trends in revenues and expenses when you compare them to the same period in the previous year. The expenses might show that some you could be overspending relative to your budget or as a percentage of your overall expenses, perhaps be showing unusual trends and areas where you may need to focus. On the other hand, it also may show areas where you are underspending and where you may have opportunity to have a greater impact on the community that you're serving. There could also be gaps in revenue for the year relative to your budget. So it may be a time to do a push for more donations or perhaps launch a fundraising campaign. It should also highlight some unusual or one-time transactions, which of course many organizations had during the COVID period. And the program revenues and expenses are also very important. And some boards may want to actually see more detail in this area, showing the actual revenues and expenses for the particular programs themselves. This information is usually invaluable for helping senior management and boards make important operating, investing, and financing decisions. And then the last statement we're going to have a look at is the statement of cash flows. So as Christine mentioned, on an accrual basis, the statement of operations doesn't reflect the monies coming in and the monies going out of the organization. But this we can see in the statement of cash flows, where it shows a sort of close-up view of your organization's spending and sources of revenues. This is also useful for uncovering potential risks and opportunities regarding your organization's financial situation. For example, you may see recurring cash outflows associated with operating activities, and you may need to focus on how quickly cash is being used and how to remediate this. The cash flow statement is usually set up to show the cash flows in 3 different categories: operating, financing, and investing activities. So operating activities really relate to exactly that, the cash inflows and outflows associated with your core operating activities. The financing activities really refer to proceeds from loans or repayments of loans that you may be receiving. And many not-for-profits are showing the CEBA loans currently as an example. Investing activities show the proceeds from any maturities of investments, as well as investments that you're choosing to make. They would also include purchases of capital assets and any proceeds on sale of capital assets. I'm now going to hand over to Christine for the next polling question.
Thank you, Shirley. That was really informative. All right, our next polling question. By reviewing your financial statements, can you identify potential red flags that may create a risk to your nonprofit? So if you saw these scenarios, which of these would create a little bit of a red flag or a raised eyebrow and lead you to ask more questions? A recent rise in legal fees. Number 2, continuous deficiencies of revenue over expenses. So that means that you're in a net deficit position continually. A dependency on one revenue stream. So for example, if all of your revenue is coming in from grants, is that a red flag? Limited reserves, so that money you have set aside for a rainy day. Excessive debt, or all of the above. So again, we're going to give you an opportunity to think about these. And if you were faced with financial statements on the board level, if you're the executive director, if you're working in finance, which of these situations, or perhaps all of these situations, would cause you to ask some questions? And so I think we're just still waiting for a few people to answer. One thing I wanted to mention when Shirley was talking about liquidity, if you don't know what liquidity is, it means turning your assets into cash. to make them liquid and available to you. So if that was maybe one of the questions that you were thinking of while Shirley was speaking, I want to remind you that we are going to be answering questions at the end of our presentation. And so we encourage you to use the Q&A throughout this presentation. And then we're going to be going through as many questions as we can. So ask away. All right, our poll is closed, and overwhelmingly 78% of our poll participants did choose all of the above. And you are correct. A recent rise in legal fees may signify legal trouble. It may or may not. It definitely warrants questions. Your agency does not want to be in a continuous deficit. While we do use the term nonprofit and we are not in the business to make profit, a deficit can absolutely affect your cash flows. It can signify that you may be overspending or you're not bringing in enough revenues to cover your expenses. Dependency on one revenue stream is never advisable. Best practice is that you have a diverse revenue stream so that you're looking at more than one stream of revenue. Limited reserves is typically a red flag, just like in our personal lives right now. And as Shirley was talking about, really just the temperature right now. People really want to have some reserves, as do organizations. And then excessive debt would signify an issue, a potential issue. So thank you so much for participating. It does give us, it's a little bit fun for us too, to kind of have you involved. So we're not just talking one-sided through this webinar. We're going to move over to revenue recognition. So let's talk about revenue recognition and why it's important to your nonprofit. So we've talked about the sources of revenue. It can be derived from donations, funding, grants. You might have fees for service. You might be selling tickets to events, grants, membership fees, sales of merchandise, and investment income. It's important to ensure that you're following guidelines related to your nonprofit, such as guidelines outlined in the accounting standards for nonprofit organizations. You also want to ensure that revenue recognition aligns with your grant agreements and other obligations you have entered into. So, depending on the type of revenue, the recognition method can change. So let's look at some examples. Donations, and we're going to talk about the deferral method specifically. And this is the one we see most commonly with nonprofits. So when you receive donations, you typically recognize them. And when we use the word recognize, in a nutshell, it just means, when does it show up in your books? So if I receive a donation today in October, today we're going to recognize it in the month that they're received. Membership revenue is usually recognized equally throughout the period of the membership. So if I am now selling a membership for 12 months, I will recognize 1/12 of that over the next 12 months. Grant revenue is often considered restricted revenue. So that means I can't spend it on whatever I want. There are guidelines and restrictions to that revenue. And it's typically recognized during the time period that the grant agreement spans. So you may have received 3-year funding, 2-year funding. And so that time span would be aligned with how you're recognizing your revenue and expenditures incurred during that time. An unrestricted grant, so that would be a grant that you receive that really has no stipulations. I mean, a lot of times those are our favorite types of grants. It's sort of use it however you want. So we typically we would recognize those much like a donation. So when they're received, we just recognize that as money into the organization. Endowment funds are recognized directly into net assets when the organization is entitled to the funds. And of course, that can vary from endowment fund. Capital contributions are recognized on the same basis as the amortization of the asset. So in the example that Shirley gave, and there was a $4,000 asset, if I donated that to your organization, you're going to recognize that on the same basis as that amortization. So it was $250 the first year, then $1,000 for 3 years, and then $750 in year 4. That's how you'd be recognizing that as well. Your financial statement should be completed by an individual or team that understands the nonprofit sector. It really is nothing like the for-profit sector. And so it's really important that you have a bookkeeping team that understands that. So in conclusion, being able to understand, interpret, and question financial statements is part of your responsibility as an executive director or member of the board of directors. It's important to be able to identify any potential risks to your organization. Accrual basis accounting provides the most accurate view of your organization's financial activities and its sustainability. Knowing how and when to recognize revenue is often required by your funder. NPO is usually the basis for preparation of the financial statements. Revenue recognition depends on factors such as accounting policy choices, what the type of revenue is, and what the requirements are of your particular funder. Choosing your bookkeeping team wisely can ensure that your books align with the proper guidelines and principles for nonprofit organizations. I'm now going to turn over the webinar to Omar to wrap up.
Thank you, Christine. If you are interested in knowing what good monthly reporting looks like or how we might be able to support you with your accounting activities, please feel free to book me for a free consultation. My email address is here on the screen, or you can go to our website and fill out our Contact Us form. We will go through your questions. We do have, I see many questions in the chat box here. So we'll get through, as I mentioned, as many of these as we can. And as long as you've provided us with your email address, we will reach out to you in the event that we don't get to your question. All right, let's jump into it.
Great. All right, so let's look at some of the questions that have come up. I'll ask this one here. We are 100% volunteer charity. We changed from the accrual method to cash method this year and are currently doing year-end adjustments. Should we book receivables and payables for a limited number of transactions? Wondering if Shirley can take that, and then I'm going to look through the other questions and choose our next one.
Absolutely. So you've mentioned you've actually changed from the accrual method to the cash method. So you would in fact not record any receivables or payables if that is the case. Receivables and payables would only be recorded if you're on an accrual method of accounting, and you don't want to combine the two. You have to keep to one or the other.
Okay.
Christine, I saw another question. This may have come in by an executive director. I find many executive directors aren't clear how much they can direct accountants in terms of line items, presentation of statements, and other things. And they aren't aware that accountants have different opinions. How much should accountants make sure that their statements are presented in ways that make sense for the organization and its purpose, and how much flexibility is there? Firstly, I just want to talk about perhaps two different types of financial statements. So you may be an organization that prepares annual financial statements in accordance with the accounting standards for not-for-profit organizations. And those financial statements may be audited or reviewed by an audit firm. In that case, you've got much less flexibility. You really do need to comply with those standards. But when it comes to your own perhaps monthly financial reporting packages, it's a free-for-all. You really should be tailoring those packages in a way that makes the most sense to your organization. and the needs of the current time from both the perspective of the executive director and the board. So absolutely have those conversations with your accountants about what you want included in the financial statements, so you can make sure you're getting meaningful information.
So I've got a really interesting but a good question here, and trust me, they're all great questions. It's so tough to pick. This person has written in and said, we have recently had a situation where an employee has caused a disturbance and brought in lawyers. And I'm just going to paraphrase the question, if I may. The organization wants to create some reserve funds, Shirley, in case of legal action taken against them. And I think that's a great idea. So they want to create some reserve funds, an HR reserve, just in case they need to buy out an employee or pay severance. What they're concerned about, though, is that it will look like a red flag on their financial statements during an audit, or when they're sharing their financial statements. So do you have any advice on that for this agency? And I also want to mention that it is always something that the auditors will ask you. So it's going to be part of the audit process that you would disclose what the fund is for, but it doesn't necessarily mean that it's a bad thing to say that you want to put money aside. So I'll leave Shirley to wrap that up.
Absolutely. So yes, it is common for many organizations to set aside what I'd actually previously referred to as internally restricted net assets. So a board may decide that a certain amount of money, and let's say it's $100,000, should be earmarked for a specific purpose. And what many organizations will do is set up that separate category within their net assets, and give it a particular name that will usually describe the purpose for which those monies are intended. And then also perhaps set up a separate bank account. So the $100,000 in this instance would be transferred to that bank account. So the monies won't actually be touched as part of the ongoing operations of the organization. It can be tricky, though. Of course, you may not want to have an internally restricted line item in your financial statements that could cause a red flag to the readers of those financial statements. So you could think about an appropriate name that wouldn't perhaps cause alarm on the part of those reading it.
That's great. So there is questions about budgeting and how difficult it is to budget. And I think we're going to just put that off to the side for a little bit, because we really want to talk about understanding financial statements here. But we do understand that it is challenging to budget in these times. And the question really is sort of, how do I budget not knowing how my grant application is going to turn out? I've applied for all these grants and I don't know how I'm going to get donations. So typically, and there's different methods for budgeting. I would definitely work with your bookkeeping team and use forecasting, and I would suggest using the last 2 or 3 years as a basis for some of that as well. Shirley, do you have any quick advice on budgeting right now in these times?
I think what's often good to do is a type of scenario analysis. So to think about various scenarios of what could actually play out over the period that you're budgeting for, and perhaps as opposed to coming up with one budget, perhaps present a number of options and likely options that would be, or possible options to the board. You do ultimately want to arrive at one sort of budget as opposed to having multiple, but that can certainly help the discussion and hopefully lead to the selection of what would be the most appropriate budget for your organization. And of course, Christine mentioned forecasting as well. So the budget's normally put in place around the beginning of a fiscal year. But of course, a different scenario could actually play out. And so you want to be creating forecasts if you think that the actual results are going to be quite significantly different to the budget. And those forecasts can be updated during the course of the year.
There's one question here that says, what exactly makes accrual accounting more complex than cash based? Again, I would say it's the difference between knowing what's come in and out of the bank. So that's cash based. Pretty simple. You look at your bank statement and you're recording right off of what came in and out of the bank. So that's the really simplistic look at financial reporting. What makes accrual accounting or accrual-based accounting more complex is that what is being entered or recorded in October only belongs to October. So it requires you understanding your monthly obligations. So for example, if you haven't received your Rogers bill yet, but you know that it belongs in October, you're going to post an accrual for that expense because you want to make sure that all of the revenue and expenses that belong to October are reflected in your books. So it's not a snapshot picture of what went in and out of the bank. It's accruing what is actually incurred that month and what revenue belongs to that month. So I hope that makes sense. And the next question, there was a really easy question for us to answer. Is depreciation and amortization the same thing? Yes. So I'm going to leave this question to Shirley so I don't take over the answers here. What would the deferred contributions cover? It's a great question.
Right. Absolutely. So we spoke about this deferred contributions account being like a parking lot. So for example, you may have a March year end, and let's assume that in March you received $100,000 from a funding organization, but that it covered the period from the 1st of April, the next fiscal year, to the end of March of that fiscal year. So you can't actually record that amount in revenue in the month that you receive it. You have to defer it, and then you can record it in the next fiscal year, which is the period that that funding actually relates to.
There's actually a couple of really, and again, there's so many good questions. So thank you so much for participating. I'm going to try to pull out a couple more because I know we are nearing the end of the webinar. Should an organization be budgeting for amortization? So it is part of your expenses on your financials every year. So I do suggest that you do. Shirley, would you suggest budgeting for amortization?
Yes, I would. And tied to that, many organizations also prepare a budget, like a capital budget. So that really sets out the amounts that they want to, or the assets rather, that they wish to purchase in the next fiscal year. And so it's good to take that into consideration when calculating the budgeted amortization amount.
So this is a really great question, and it ties into the cash flow statement. How do you calculate available cash, since that doesn't mean the same as the surplus amount? It's a great question. And it really ties into as well restricted cash and unrestricted cash. So there are some organizations that might have, and you're talking about the surplus, which is true, but you might have accumulated cash that is available to use. And what's really important to understand too is that there's restricted cash and unrestricted cash, and restricted cash is not available to use necessarily. So I years ago had an organization that I was working with where they had money put aside for a certain, if they incorporated, and they weren't going to incorporate. And so that money was sitting in the bank and they couldn't use it. So that's cash we can't use. So our cash flow, our statement of cash flow, should separate restricted and unrestricted cash to give you an idea of how much cash is available for use for unrestricted instances that is ready to use. Shirley, do you have anything to add to that?
Yes, what you could also consider doing is also doing cash flow projections. So you can get a sense of any excess cash that you may have, that you may wish to invest as well, over and above the cash that you know that you'll actually need for your operating activities.
Thank you, Shirley. We are pleased to extend the Q&A portion by an extra 10 minutes so the Enkel team has a bit more time to answer a few more questions. But before you jump back into the Q&A, I just wanted to remind everyone that they will receive a copy of the full webinar recording and resources by email tomorrow. So if anyone has to leave early, please don't worry about missing any of the content. So back to you.
Thanks, Mercedes. And I just want everyone to understand we will happy to answer questions for another 10 minutes. What I'm noticing is we have so many questions that we're not going to get to every one of them. And I'm not choosing them based on what's a better question than the other. So if you're sitting here and yours doesn't get answered directly during the webinar, I'm sure it's a great question. It's just there's a lot to scroll through. So I'm just kind of picking them randomly. They're all fantastic questions. So here's one. Should your grants show on your monthly financial statements? That was a very recent question that came through. So your grants will actually show in a couple of your financial statements. So when you bring in let's say a grant deposit of $300,000, and that's meant for 2 years, part of that's going to show under the deferral method. Part of that's going to show on your balance sheet under deferred revenue, which means it's sitting off to the side and not recognized as revenue yet. Then you're going to see it on your profit and loss or statement of operations in the nonprofit world. And it's going to be brought or recognized into revenue based on that grant agreement. So you might be recognizing a portion of it equally every month. If it was a 12-month grant, you might choose to recognize 1/12 of that revenue every month, or you might match it to spending. You might say, well, as much money as we're spending, we're going to recognize that much in revenue. So your grants do show up in your financials. Yes. Let's see. How do you record? I'm going to leave this one to Shirley. How do you record donated space by a founder?
That's a good question. And that again comes down to an accounting policy choice. So it's what is called a donated, I would put it into the donated service category. So some organizations will choose to recognize both revenue and expense, and that would be in an equal amount associated with the donated services. Other organizations may choose not to recognize it. If you do choose to recognize it, though, you do need to meet certain criteria before you can record it on your in your profit and loss. And normally you have to be able to reasonably determine the market value of that service. So if you had, in fact, paid for that service and you were dealing at arm's length with the landlord, what would you have paid? And you would need to have used that service and paid for that service anyway. And normally in the context of rent, you would be, because you're needing to use those facilities. So if you choose to firstly recognize those donated services in your books and you meet the criteria, then you would record an equal amount of revenues and expenses. So the expense would be a rent expense and the revenue could be something like an in-kind donation.
Great. So I'm going to try to get some questions answered that we've been getting from a few different people. But I'm going to pull this question out here. Is it the board's discretion or the auditor's discretion to determine the depreciation of assets? As in, is it straight line? Is it 20% or 30%? The answer is we follow accounting guidelines. And so it would be your auditor, your accountant, that would be following those guidelines. Shirley, would you like to add anything to that?
Yes, actually I would. So yes, the accounting standards need to be followed, but usually it's management of the organization that would choose the particular method and the useful life of an asset. It's often an area of judgment because one doesn't know exactly how long you're going to be using a particular asset for. But you make your best estimate at the time. The method of amortization would usually be one that you believe is most suited to your organization. Yes, and then it's over to, as Christine said, following the particular accounting guidelines in terms of the actual recording of the amortization.
Thanks, Shirley. And another thing that we want to consider is what your threshold is. So, for example, when clients join Enkel, that's one of the first questions we ask them in onboarding. One of the many questions is, what is your threshold for capital assets? What is your threshold for prepaids? And there are times, it's quite common for a board of directors or an executive director to not know what the threshold is. So what does that mean? It means that what is that sort of bare minimum amount of money that you would pay for a capital asset and then want to amortize it. And I did note in the questions that there's still some people that are unclear on what amortization means. So very quickly, what it means is that you are considering the life of an item and how long it's expected to last. So a computer, for example, might be 3 years, and then we have to buy another computer. A table might be 10 years. It's going to last a lot longer. So amortizing a capital asset just means that you are recognizing that its life is going to be past this fiscal year, and you're going to come up with strategy to amortize that. So the threshold means, are we going to capitalize a computer mouse just because we know it could last 3 years? And the computer mouse might be $20. Typically, organizations and on the board level will talk about thresholds, and it might be the executive director that makes that decision. But you will want to also consider thresholds for prepaid expenses as well as capital assets. So it's just something to kind of think about as well. All right, let's see if we have one last question. I'm actually going to let Shirley take this one as well, because I've seen this at least 3 times. It's such an important question, and I know it's important that we deal with it today. The nonprofits and charities want to know if they can get their GST back. So it's not a simple question, but we'll try to just give you a really quick overview because there's a difference between a charity and a nonprofit, nonprofits being qualifying or non-qualifying. So Shirley, I'll leave it up to you to kind of summarize that, because I've seen that at least 3 times in the questions.
Yes. So there is what is referred to as the public service bodies rebate, and all charities are entitled to claim this rebate. It's normally set at 50% of the GST you paid, or 50% of the federal portion of HST. Now, if you are not a charity but a not-for-profit organization, you need to take another step and determine whether you are what the CRA refers to as a qualifying organization or not. If you are a qualifying organization, your government funding revenues need to represent a minimum of 40% of your overall revenues for a fiscal year. But if you are a qualifying not-for-profit organization, you can also claim that rebate in the same way that a charity can. It's just reported on a different line in the particular form.
So we always suggest, sorry, I didn't mean to cut you off, Shirley.
Oh, no, I just wanted to make absolutely sure that you understand whether you are a qualifying not-for-profit or not, so that you can take advantage of those rebates.
Yeah, I think what's really important, Shirley, is that an organization understands what their status is. Are you a qualifying nonprofit, Are you a non-qualifying? Are you a charity? And just know that you don't have to register for GST to get GST back. So definitely question for your year-end accountant. But in most cases, and often, you are eligible to receive some of the taxes back. So with that, we will wrap up this webinar, and we thank you so much for participating. The participation in the polls and just showing up today means a lot to us. And just to remind you, please feel free to book a free consultation with Omar. Such a friendly face, but also comes with a lot of knowledge, and he's fantastic to talk to. So please reach out through email, and our website is there as well. Thank you so much for participating in today. We really appreciate it.
Thank you very much, Christine. We appreciate you taking the extra time to cover so many questions for the attendees. Omar, do you happen to have any final comments before we sign off today?
No, again, thank you very much for having us. We love running these sessions. I see that we have, I think, more questions than we've ever had out of a webinar, which is fantastic. So we have a lot of work to do. Just a reminder, if you are interested in speaking about how we can support you, what Enkel is doing for other not-for-profit organizations to help them manage their financial back office, we would be happy to speak, and my contact information is right here. Thank you again.
Thank you, Omar. On behalf of Charity Village, I would like to thank the entire Enkel Back Office Solutions team for presenting such an informative webinar. I just wanted to remind everyone that you will receive a follow-up email tomorrow with a link to the webinar recording. Please feel free to share this link with your colleagues. The email will also include a survey link that you can fill out with your feedback on today's webinar. You should see a survey link pop up right here in Zoom following the session as well. Thank you so much for joining us today. I hope you'll join us for our next free webinar, Top 10 Compliance Issues for Canadian Registered Charities. You can find more information on this and all of our upcoming webinars at charityvillage.com/webinars. Thanks again for joining us today. I wish you all a wonderful rest of your day.